Listen carefully, because what I'm about to share with you could mean the difference between protecting your wealth and watching it evaporate in the coming weeks. Right now, at this very moment, something is happening in the gold market that most investors won't understand until it's too late. And by then, the opportunity to position yourself will have vanished. Let me paint you a picture of what's unfolding. Over the past 72 hours, we've seen a convergence of events that hasn't occurred in over 4 decades. Central banks are moving gold at a pace we haven't witnessed since the 1970s. The COMEX warehouses are showing inventory levels that would have been unthinkable just 6 months ago, and perhaps most telling, the smart money, the institutions that have access to information you and I will never see, they're making moves that suggest they know something the general public doesn't. I've been analyzing precious metals markets for years, and I can tell you with absolute certainty that what we're seeing right now is not normal market behavior. This is the kind of setup that comes along maybe once or twice in a lifetime. The kind of setup that, if you understand it and act on it, could fundamentally change your financial future. Let me take you back to March of 1968. Most people don't remember this, but there was a moment when the London gold pool collapsed. For years, central banks had been working together to suppress the price of gold, to maintain the illusion that paper currencies were stable and reliable. They were selling gold into the market, trying to keep the price anchored at $35 an ounce. But then, something happened. The demand became too great. The physical gold started disappearing from the vaults, faster than they could replenish it. And suddenly, almost overnight, the entire system fell apart. What followed was a price explosion that caught almost everyone off guard. Gold went from $35 to over $800 within 12 years. The people who understood what was happening, who positioned themselves before the crowd figured it out, they didn't just preserve their wealth. They multiplied it many times over. Now, I'm not saying we're in exactly the same situation, but I am saying that the parallels are impossible to ignore. And the warning signs we're seeing today are, in many ways, even more dramatic than what we saw back then. Let's talk about what's actually happening right now in the physical gold market. The COMEX, which is the primary exchange where gold futures are traded in the United States, has been experiencing something extraordinary. The amount of gold available for delivery has been declining at an accelerating rate. We're talking about a drawdown that, if it continues at the current pace, could see deliverable gold inventories reach critically low levels within weeks, not months. Now, you might be thinking, so what? Why does that matter? Here's why it matters. The COMEX operates on a fractional reserve system. For every ounce of physical gold in the warehouse, there are multiple paper claims on that gold. It's similar to how banks operate, where they don't actually keep all your deposits in the vault. They lend most of it out, operating on the assumption that not everyone will want their money at the same time. But what happens when everyone does want their money at the same time? What happens when the holders of those paper gold contracts start demanding physical delivery? That's when you get what's called a squeeze. And a squeeze in the gold market is unlike anything most investors have ever experienced. I want you to imagine a game of musical chairs. Except in this version, there are 100 people playing, but only 10 chairs. As long as the music keeps playing, everyone's happy. They're walking around, confident that when the music stops, they'll find a seat. But the moment that music stops, the moment people realize there aren't enough chairs, that's when panic sets in. That's essentially what we're looking at in the gold market right now. There are far more claims on physical gold than there is actual physical gold available, and the music is starting to slow down. Let me give you some specific numbers, because this isn't speculation. This is documented fact. As of last week, the COMEX registered gold inventory, that's the gold that's actually available for delivery, stood at approximately 2.1 million ounces. Now, that might sound like a lot, but when you compare it to the open interest, the number of contracts that could potentially demand delivery, we're looking at a ratio that's approaching dangerous territory. In a normal, healthy market, you want to see plenty of physical gold backing those paper contracts. You want a comfortable cushion. But right now, that cushion is getting thinner by the day. And here's what makes it even more concerning. The rate of withdrawal has been accelerating. In the past month alone, we've seen over 300,000 ounces leave the COMEX warehouses. That's not normal profit-taking. That's not routine market activity. That's someone, or more likely multiple someones, who want physical metal in their possession, and they want it now. Who's taking delivery? That's the question everyone should be asking. Because it's not retail investors. The average person buying gold is purchasing coins or small bars from a dealer. They're not going through the COMEX. The entities taking delivery from the COMEX are large institutions. We're talking about sovereign wealth funds, central banks, major financial institutions. These are the players who have the resources and the connections to move serious weight. And they're not doing this because they think gold might go up a little bit. They're doing this because they're preparing for something. They're positioning themselves for a scenario where having paper claims on gold isn't going to be good enough. They want the physical metal, and they want it in their vaults, under their control. Now, let's zoom out and look at the bigger picture, because what's happening at the COMEX is just one piece of a much larger puzzle. Central banks around the world have been net buyers of gold for over a decade now, but in the past 2 years, that buying has gone into overdrive. In 2022, central banks purchased over 1,100 tons of gold. That was a record. Then, in 2023, they bought even more. We're talking about the most aggressive central bank gold accumulation in modern history. Why? Why are central banks, the very institutions that issue paper currencies, buying gold at record levels? Think about that for a moment. These are the people who print money. They can create dollars, euros, yen, whatever they need, out of thin air. And yet, they're using those currencies to buy gold. What does that tell you about their confidence in the long-term value of paper money? The answer is obvious. They're hedging. They're diversifying away from dollar-denominated assets. They're preparing for a world where the current monetary system might not function the way it has for the past 50 years. And it's not just any central banks doing this. It's specifically the central banks of countries that have been vocal about wanting to reduce their dependence on the US dollar. China has been steadily increasing its gold reserves. Russia, before the sanctions, was one of the most aggressive buyers. India, Turkey, Poland, these countries are loading up on gold. They're not doing this randomly. This is a coordinated strategy. There's a term that's been floating around in financial circles lately, de-dollarization. It sounds technical, but the concept is simple. For decades, the US dollar has been the world's reserve currency. International trade, especially oil, has been conducted primarily in dollars. This has given the United States enormous economic and geopolitical power. But that system is starting to crack. Countries are beginning to settle trade in their own currencies. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been discussing the creation of a new currency that could rival the dollar. Saudi Arabia, which has priced its oil exclusively in dollars since the 1970s, has been in talks with China about accepting yuan for oil payments. These aren't just headlines. These are fundamental shifts in the global economic order. And when you have that kind of uncertainty, when the bedrock of the international financial system is being questioned, where do people turn? They turn to gold. Because gold doesn't have counterparty risk. Gold doesn't depend on any government's promise. Gold is the ultimate form of money that has held value for thousands of years, across every civilization, through every crisis. Now, I want to shift gears for just a moment. Because if you're sitting on $100,000 or more in retirement accounts, there's something you need to know. I've put together a free guide on how gold IRAs work. It's in the description below. This guide covers how you can get physical gold into your retirement account without triggering tax penalties. It explains the process, the rules, the custodians you need to work with. If protecting your retirement savings is a priority for you, and it should be, this is worth checking out. No obligation, just information that could be valuable for your situation. All right, back to what's happening in the market right now. Because the central bank buying and the COMEX inventory situation, as significant as they are, they're still just part of the story. We also need to talk about what's happening with mining supply. Gold mining is not like turning on a faucet. You can't just decide to produce more gold because the price is going up. It takes years, sometimes decades, to bring a new mine into production. You have to find the deposit, which is increasingly difficult because most of the easy-to-find gold has already been discovered. Then you have to get permits, which in many jurisdictions can take 5 to 10 years. Then you have to build the infrastructure, the roads, the processing facilities, the power supply, and then finally you can start extracting gold. What this means is that gold supply is relatively inelastic. It doesn't respond quickly to changes in demand. And right now, we're seeing a situation where demand is surging, but supply is constrained. Global gold mine production has been essentially flat for the past few years. Some analysts are even predicting that we may have already reached peak gold production, meaning that from here on out, the amount of gold mined each year will decline. Think about the implications of that. Demand is increasing. Supply is flat or declining. What happens to price in that scenario? It's basic economics. The price has to go up. The only question is, how much and how fast? But there's another factor that's even more important than mine supply, and that's the flow of gold from west to east. For decades, gold has been moving from western vaults to eastern vaults. London and New York, used to be the centers of the gold market, but increasingly, the action is in Shanghai, Hong Kong, Singapore. The East is accumulating gold, and the West is selling it. This isn't a short-term trend. This has been happening for years, but it's accelerating, and at some point, the West is going to run out of gold to sell. When that happens, when the physical gold in Western vaults is depleted to the point where there's not enough to meet demand, that's when you get a price reset. Not a gradual increase. A reset. A repricing of gold that reflects its true scarcity and its true value as a monetary asset. I've talked to people who work in the vaults, who see the physical gold moving, and they're telling me that the pace of withdrawals is unlike anything they've seen in their careers. Gold, that's been sitting in London vaults for decades, is suddenly being shipped to Asia. Bars that were stored in New York are being flown to Switzerland and then on to Hong Kong. This is real metal, moving in real time, and it's leaving the Western financial system. Now, let's talk about the paper gold market, because this is where things get really interesting. The vast majority of gold trading doesn't involve physical metal. It's all done through derivatives, futures contracts, ETFs, certificates. These are paper claims on gold, and they trade at volumes that dwarf the actual physical market. The problem with paper gold is that it's vulnerable to manipulation. And I'm not talking about conspiracy theories here. This is documented fact. Multiple banks have been fined for manipulating the gold market. In 2020, JP Morgan was fined nearly $1 billion for spoofing the gold and silver markets. Spoofing is when you place large orders that you have no intention of executing, just to move the price in a direction that benefits your other positions. It's illegal, and it's been happening for years. But here's the thing. That manipulation only works as long as the market remains primarily paper-based. As long as most gold trading is done through contracts that never result in physical delivery, the price can be controlled. But when people start demanding physical metal, when they stop trusting the paper claims and insist on holding the real thing, that's when the manipulation breaks down. And that's exactly what we're starting to see. The premium for physical gold over the paper price has been widening. In some markets, particularly in Asia, you're paying significantly more for a physical gold bar than what the futures price would suggest. That spread, that premium, is telling you that there's a disconnect between the paper market and the physical market. And when that disconnect becomes too large, something has to give. History gives us a roadmap for what happens next. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's money. But gold didn't get there gradually. It spiked. In the final months of the bull market, gold went parabolic. People who waited, who thought they had time, they missed the bulk of the move. The same thing happened in 2011. Gold had been in a bull market for a decade, rising steadily from around $250 to over $1,900. But the final push, from $1,500 to $1,900, happened in just a few months, and then it was over. The bull market ended, and gold entered a multi-year correction. The point is, these moves happen fast. When gold decides to run, it doesn't send you an invitation. It doesn't wait for you to get comfortable. It just goes. And if you're not positioned beforehand, you're chasing. And chasing in a parabolic market is a recipe for disaster. So what's different this time? Why should you believe that we're on the cusp of another major move? Because the fundamentals are stronger than they've ever been. In 1980, gold was rising primarily because of inflation. The Fed had lost control of the money supply, and people were fleeing into hard assets. But the underlying financial system was still intact. The dollar was still the reserve currency. The global economy was still functioning. Today, we have inflation. Yes, but we also have unprecedented levels of debt. We have central banks that have expanded their balance sheets to levels that would have been unimaginable a generation ago. We have geopolitical tensions that are fracturing the global economic order. We have a crisis of confidence in institutions, in governments, in the very idea that paper money will hold its value. This isn't just an inflation hedge play. This is a systemic risk play, and systemic risk is much more powerful than inflation as a driver of gold prices, because when people lose faith in the system itself, they don't just want to preserve purchasing power. They want to get out of the system entirely. And gold is the exit. Let me tell you about a conversation I had recently with someone who manages money for ultra-high net worth individuals. We're talking about people with hundreds of millions, some with billions. And he told me something that stuck with me. He said, "My clients aren't buying gold because they think it's going to double. They're buying gold because they're terrified of what happens if the system breaks. They're buying insurance. and they're willing to allocate serious money to that insurance because the potential downside of not having it is catastrophic. That's the mindset of the smart money right now. They're not trying to time the market. They're not trying to squeeze out an extra few percentage points of return. They're protecting themselves against tail risk. They're preparing for scenarios that most people don't even want to think about. And here's what's crucial to understand. When those scenarios start to unfold, when the general public starts to wake up to the risks, that's when you get the panic buying. That's when you get the lines outside the coin shops. That's when premiums explode and availability disappears. By the time the mainstream media is telling you to buy gold, it's too late to get in at a reasonable price. Right now, we're in the window. We're in that period where the warning signs are visible if you know where to look, but the crowd hasn't caught on yet. The gold price is elevated, yes, but it's not in bubble territory. You can still buy physical metal without paying outrageous premiums. You can still position yourself before the rush. But that window is closing. Every day, more gold leaves the COMEX. Every week, central banks add to their reserves. Every month, the geopolitical situation becomes more unstable. The fuse is lit. We just don't know how long it is. I want you to think about your own situation for a moment. How much of your wealth is tied up in paper assets, stocks, bonds, cash in the bank? All of those things are claims on a system. They're promises. And promises are only as good as the entity making them. If you have faith that governments will remain solvent, that central banks will manage inflation, that the financial system will continue to function smoothly, then maybe you don't need gold. But if you have even a sliver of doubt, if you look at the debt levels and the money printing and the geopolitical chaos and think, this might not end well, then you need to ask yourself, what am I doing to protect against that outcome? Gold isn't a get-rich-quick scheme. It's not a speculation. It's a form of wealth that has survived every crisis, every empire, every monetary system that has ever existed. When the Roman Empire fell, gold still had value. When the Weimar Republic's currency became worthless, gold still had value. When the Soviet Union collapsed, gold still had value. The question you need to ask yourself is not whether gold will go up. The question is, can you afford to be wrong about the stability of the current system? Because if you're wrong, if things do fall apart, the cost of not having gold will be far greater than the cost of buying it and not needing it. We're living through a moment in history that will be studied for generations. The decisions being made right now by central banks, by governments, by major financial institutions, these decisions are setting the stage for what comes next. And what comes next could be a reset of the entire global financial system. I'm not saying this to scare you. I'm saying this because it's the reality of the situation. The data is clear. The trends are undeniable. The smart money is positioning itself. The only question is whether you're going to join them or whether you're going to wait and hope that everything works out. These next hours, these next days, they matter. Not because gold is going to double overnight, but because the opportunity to position yourself at reasonable prices with reasonable availability is finite. Once the crowd figures out what's happening, once the mainstream catches on, the game changes. Premiums spike, availability dries up, and you're left scrambling. I've given you the information. I've shown you what's happening in the COMEX warehouses, what central banks are doing, how the physical market is tightening, why the fundamentals are stronger than they've ever been. Now it's up to you to decide what to do with that information. But I'll leave you with this final thought. In every major financial crisis, there are people who see it coming and prepare, and there are people who don't. The people who prepare, they don't just survive. They thrive. They come out the other side wealthier and more secure than they were before. The people who don't prepare, they're the ones who lose everything. Which group do you want to be in? Because the choice is yours. But the clock is ticking, and these next hours could be critical.